After studying this module, you shall be able to know the various capital structure theories, learn the assumptions under which the capital structure theories work, identify the various constants under each theory, evaluate the value of firm and cost of capital under different theories. The value of the firm depends on the earnings of the firm. The earnings of the firm are divided among three main claimants. Number one, the debenture holders. They receive their share in the form of interest. Number two, the shareholders. They receive their share in the form of dividends. They can either be preference shareholders who receive fixed rate of dividend or equity shareholders who claim the balance or residual earning. Third, the third claimant is government, which receives its share in the form of taxes. However, what is worth noting is that the order of payment is not as above. First, interest is paid to the debenture holders, and then the government gets the share in the form of taxes, and then finally comes the shareholders. Thus, interest is a deductible expense for calculating taxes, but dividends are not expenses. Dividends are paid out of profits after tax. These earnings of the firm are capitalized at the rate equal to the cost of capital to find out the value of the firm. The earnings of the firm, that is EBIT, is determined by the investment decision. The more investments are made, the more EBIT would be generated. How this EBIT is to be shared amongst various claimants depends upon how the investments have been arranged. The capital structure determines the mix of the investment and the share of claimants in the EBIT. Thus, the value of the firm would be the sum total of value of debt holders and shareholders. The total return on total investment does not change. However, if the debt component is higher, the financial leverage affects the amount available to shareholders. This will affect the value of equity shareholders and the value of the firm. Thus, overall cost of capital, that is weighted average cost of capital WACC, can be changed by changing the financial mix. Therefore, we can surely find a mix which gives lowest WACC and highest value to the firm. This would give an optimal capital structure. Theories of capital structure. Different theories have been expressed regarding the relationship between the leverage, cost of capital, and value of the firm. These relationships are also expressed as theories of capital structure. These are: number one, net income approach; number two, net operating income approach; number three, traditional approach; number four, approach or Modigliani and Miller approach. These theories are based on the following assumptions. Number one, the firm's business risk is given and is not affected by financial mix. Number two, there are only two sources of funds, that is debt and equity. Number three, the total assets of the firm are given and no change would be there in total investments. Number four, operating profits are given and would remain same. Number five, entire profits are distributed and there are no retained earnings. Number six, there is no corporate or personal tax. While discussing these theories, the following notations are used. V is the value of firm, S is the value of equity, B is the value of debt. V is determined or equal to EBIT upon KO and V is equal to S plus B. I is equal to interest payment, EBIT is equal to earnings before interest or net operating profit, NP is equal to net profit or profit after tax. KD is equal to cost of debt after tax. K is cost of equity and KO is the overall cost of capital, that is WACC. Also, KO is equal to EBIT upon V. Net income approach. This theory states that there is a relationship between capital structure and the value of the firm. Therefore, the firm can affect its value by increasing or decreasing the debt proportion in the overall financing mix. The net income approach is based on the following assumptions. KD and KE remain constant, and therefore as leverage increases, KO nears KD. KD is always less than KE, thus implying that KO will reduce with leverage. This graph you can see that KE and KD are shown as straight line, which means they are constant, and KO is the red line which is reducing with the increase in leverage. The theory states that as financial leverage increases, the overall cost of capital WACC decrease as KD is assumed to be less than KE. This results in increased returns to the shareholders, thus increasing the value of the firm. On the other hand, if debt will decrease in the capital structure, the overall cost will increase and reduce the value of the firm. Let's look at illustration 1. EBIT of the firm is rupees 2 lakhs. K is equal to 12%, KD is equal to 8%, and debt is equal to B equal to 5 lakhs. Find the value of the firm and overall cost of capital, that is WACC. Solution. EBIT is equal to rupees 2 lakhs. Now deduct interest from there. On 5 lakhs at 8% rate of interest, the amount comes to 40,000. So net profits available to equity shareholders is equal to 1,60,000. Since K is 12%, so the value of equity S is 1,60,000 divided by 12%. This is equal to 13,33,333.33. Now value of the firm B is equal to B plus S. This is equal to 5 lakhs, that is the value of debt, plus 13,33,000 which we have just calculated, and the total value of the firm is equal to 18,33,333.33. Now WACC divided by KO is equal to EBIT upon V. This is equal to 2 lakhs divided by 18.33 and odd multiplied by 100 is equal to 10.90%. WACC can also be calculated using the formula KD into D divided by D plus E plus KE multiplied by E divided by D plus E. So when you calculate or put the amount in the formula, you will get the overall cost of capital as 10.91%. Limitations of net income approach. Net income approach is simple, but it is based on unrealistic assumptions that risk perception of equity will remain constant at all degree of leverage. The more debt will be there in the capital mix, the equity will demand more risk premium as their risk will increase. Net operating income approach. According to NOI approach, the market value of the firm depends upon the operating profit and overall cost of capital, that is KO. The financing mix is irrelevant and does not affect the value of the firm. The assumptions of this theory are: 1. The investors perceive the firm as a whole and capitalizes its total earnings to find the value of the firm. Therefore, KO is constant. KD is also taken as constant. Third, increase in debt increases the risk of shareholders, and thus KE increases with increase in debt. Now let's look at the illustration 2. Here EBIT is 2 lakhs, KO is 10%, KD is 8% and debt is 5 lakhs. Solution. V, the value of the firm, is EBIT divided by KO. This is equal to 2 lakhs divided by 10% is equal to 20 lakhs. Further, V is equal to B plus S. That means 20 lakhs is equal to 5 lakhs plus S. This will give us S equal to 15 lakh. Now, amount available to equity shareholders, EBIT is 2 lakhs minus interest on 5 lakhs at 8% is 40,000, and net profits available to equity shareholders is 1,60,000. Now K is determined dividing PAT by S. So the value of equity S is 1,60,000 divided by 15 lakhs multiplied by 100 equal to 10.67%. Now in this graph, you can see clearly that KO and KD are constant, while the cost of equity increases, that is KE increases with the increase in leverage. Limitations of net operating income approach. The major limitation of net operating income approach is that the cost of debt remains constant regardless of the degree of leverage. Another drawback is, as the cost of capital of the firm cannot be altered through leverage, the net operating income approach implies that there is no optimal capital structure. Traditional approach. The NI approach and NOI approach hold extreme view on relationship between the leverage, cost of capital and value of the firm. In traditional situation, both the approaches are unrealistic. The traditional view takes the middle approach. It says the value of the firm can be increased by increasing the leverage only to an extent. Therefore, this is more practical and can be used to decide a point where the value of the firm will be maximum and overall cost of capital will be minimum. Assumptions of this theory. The traditional approach has the following assumptions. The cost of debt capital remains more or less constant up to a certain degree of leverage, but rises thereafter at an increasing rate. The cost of equity capital remains more or less constant or rises only gradually up to a certain degree of leverage and rises sharply thereafter. The average cost of capital decreases up to a certain point due to the benefit of leverage and then starts increasing. The point where it is lowest is the optimal capital structure. The approach. It states that the cost of debt KD will be less than KE. For all equity firm, KO will be equal to KE. So if debt is introduced at a lower cost, the overall cost will come down as KO or WACC will reduce with small degree of leverage. The risk of equity will also not increase and therefore KE will remain constant up to this level. But if leverage is increased further, KE may start increasing, but the benefit of the leverage will be more than the increase in KE. Therefore, KO will still come down. Beyond this point, the KO will increase with increase in leverage, but its adverse effect will not be compensated with benefit of leverage. So at this point, there is no point of raising money through debt as it will increase the WACC, that is KO, and reduce the value of the firm. The debts also start demanding more as their risk also increases. This you can see clearly from the graph that the overall cost of capital will start increasing beyond a certain amount of leverage. Let's look at the illustration. ABC Limited, having an EBIT of 2 lakhs, is all equity firm with KE of 12.5%. It is thinking of rendering part of capital with debt financing. It is completed through two options. Option 1, debt of 6 lakhs at 10% per annum. KE will increase to 13% at this level. Option 2, debt of 8 lakhs at 11% per annum. This will increase the risk of equity and KE will increase to 14.5%. Should the firm opt to redeem its capital? If yes, which option should be the firm exercise? Now you look at the solution in the table. The first column is talking about EBIT minus I, which gives you PAT, which again is giving you KE, values of KE, S, B, and the value of the total firm. V is equal to B plus S, and then overall cost of capital. The second column is talking about the situation where there is no debt in the business. In that case, EBIT is 2 lakhs. There is no interest payment. PAT is 2 lakhs. KO is 12.5%. So when you divide 2 lakhs by 12.5%, you get V as 16 lakhs because the value of debt is nil. And overall KO is 12.5%. Now look at the third column. Here you have taken a debt of 6 lakhs. EBIT is again 2 lakhs. The interest on this is 60,000. The PAT 1,40,000 and K is gone up to 13%. In that case, the value of the equity shareholders is 1,40,000 divided by 13% and value of debt is 6 lakhs. So the two combined together give you a total of 16,70,923 and the overall cost of capital is 11.926%. Let's look at the last column. Here the debt is 8 lakhs, EBIT is 2 lakhs, the interest payable on 8 lakhs is 88,000, the PAT available to equity shareholders is 1,12,000, the cost of equity is 14.5%. So this gives the value of S as 1,12,000 divided by 14.5% and the value of debt is 8 lakhs. The combined together you get the total value of 15,72,414 and overall cost of capital is 12.719%. Thus it is better if the firm employs some degree of leverage. It should borrow 6 lakhs at 10% and redeem equity. It will be able to reduce its WACC from 12.5% to 11.926%. But if it tries to raise more debt, it will be available at a higher rate of 11% and KE will also start demanding more return for higher risk. It will lead to increased overall cost and reduce the value of firm. Therefore, the firm should raise debt only to the extent of rupees 6 lakhs at the rate of 10%. Modigliani-Miller approach. This model propagates that capital structure and its composition has no effect on the value of the firm. They have shown that the finance leverage does not matter and the cost of capital and value of firm are independent of the capital structure. They have restated the NOI approach and have added to it the behavioral justification for this model. The assumptions of this theory are as under: 1. Capital markets are perfect and complete information is available to all the investors. Number 2. The investors are rational, informed, and can borrow and lend funds at the same rate. Number 3. Securities are infinitely divisible. There are no transaction cost. Number 4. There is no corporate income tax. Investors can substitute personal leverage in the corporate. That is, personal leverage and corporate leverage are perfect substitutes. The approach. Let's understand the approach with the following illustration. Illustration 4. Let's take two firms. One is firm A, which is leveraged firm, and the other firm B, which is unleveraged. The firms are alike in all respect except that the firm A has 10% debt of rupees 5 lakhs in its capital structure. On the other hand, firm B is all equity firm. Both the firms have an EBIT of rupees 2 lakhs and equity capitalization rate of 20%. Under the given circumstances, the WACC of the two firms shall be as follows. Now look at the table. Column 1 is self-explanatory. The column 2 talks about the leveraged firm. EBIT is 2 lakhs. Interest on 5 lakhs is 50,000. Profit after tax is 1,50,000. That is available to the equity shareholders at 20%. So the value of the shareholders portion of the firm is 1,50,000 divided by 20%, which gives you 7,50,000. The value of the debt is 5 lakhs. So the total value of the firm A is 12,50,000. Consider the firm B in the last column. This is unlevered. EBIT is 2 lakhs. Interest is nil. The entire profit after tax is 2 lakhs. And capitalization rate is 20%. So this gives us the equity portion of the value as 2 lakhs divided by 20%, which is equal to 10 lakhs. Since the value of the debt is nil, the overall value of the firm in this case is 10 lakhs. Now you can visibly see that the value of the levered firm is more than unlevered firm. Thus, NOI approach has been substantial, but as per MM approach, this situation cannot persist in the long run. What will investors do? Investors will start selling the shares in the leveraged firm as they will get increased value and start buying shares in unleveraged firm with personal loans and increase their value in unlevered firm. So equilibrium will be restored. The investor will do so as he sees an arbitrage opportunity here. Arbitrage means increasing returns without increasing risk or investment. The arbitrage process. Let's take an investor who has 10% equity stake in firm. Firm A has 1,50,000 as net profits for shareholders and the value of its equity shares is 7,50,000. So Mr. X has an income of 15,000. He can sell the share in firm A for 75,000. Mr. X does the same, that is, he sells the shares in firm A for 75,000. He now raises 50,000 from market at 10% interest. He now has 1,25,000 to invest in stake of 12.5%. That is 1,25,000 divided by 10 lakhs, which is the value of the unlevered firm. He will now get an income of 12%, which will be about 2 lakhs. Rupees 20,000 from firm A, from this income, he pays interest of 5,000 because he has borrowed 50,000 at 10%. he is left with 20,000 as income. So we can see that Mr. X has increased in income or return without any risk on investment. Since all investors are rational and will continue the process of arbitrage, the prices of shares of firm A will go down, thereby reducing its value, and shares of firm B will go up, increasing the value of the firm B till equilibrium is reached. Thus, leverage is relevant in determining the value of the firm or cost of capital. Limitations of MM approach. The major limitation of MM approach is the assumptions that underline it. These assumptions are unrealistic and unattainable. Markets are not perfect. Transactions are not cost-free. In fact, investors also do not behave in a perfectly rational manner. The following limitations are: number 1, corporate and personal borrowings are at different rates. It's not possible for the individuals to borrow at the same rate at which companies borrow. Personal leverage is not a substitute of the corporate gearing. The leverage capacity of the firms is higher than the individual. Personal borrowings are cumbersome and it creates inconvenience as there are many formalities involved. In real life, there are transaction costs. There are legal restrictions in buying and selling securities by institutional investors. Complete information is not available in the market, and there are corporate and personal taxes. Later on, MM hypothesis relaxed the assumptions that there are no corporate taxes, and it realized that a value of levered firm increases because the levered firm has to pay less taxes. That is, interest is deductible in calculating profits for tax purposes. Thus, a levered firm has larger share of EBIT to the debt and equity shareholders. The value of the levered firm will be equal to the value of unlevered firm plus tax shield. The tax shield is the tax benefit which accrues to levered firm and is given by B, that is the tax rate. Practical illustrations. Illustration 5. Z Limited with EBIT of 3 lakhs is evaluating the various possible capital structure. Sum of the capital structure is given below. Which one of the following given structure would you recommend? Now look at this table. First column talks about capital structure 1, 2, 3, 4, 5. Now debt in the second column is shown as 3 lakhs, 4 lakhs, 5 lakhs, 6 lakhs, 7 lakhs. You see the third column, the KD, that is the rate of interest payable on debt, is 10%, 10%, 11%, 12% and 14%. Correspondingly, the value of equity also goes up from 12%, 12.5%, 13.5%, 15% and 18%. Now solution. Thus, it is traditional approach where KD and KE both are increasing with increased leverage. As risks are increasing, we have to choose that capital structure which increases the value of the firm and reduces overall cost of capital. Now look at the capital structure table. Row 1 is talking about the different capital structure. Row 2 is talking about the degree of debt which is taken. Row 3 is EBIT, which is constant for all the situations. I varies along with the debt, and corresponding to the rate of interest available, it is 30,000, 40,000, 55,000, 72,000 and 98,000. PAT correspondingly for this comes down from 2,70,000 to 260 to 245, 228 and 202. The KE goes up from 12 to 12.5, 13.5, 15 and 18. The value of the equity shareholder firm, you see it is going down from 22,50,000 to 20,80,000 to 18,14,000, 15,000, 15,26,000 and like that. But what about the overall value of the firm? When we add the value of debt to the value of equity, you see that in the first column the value of the firm is 25,50,000 and the overall cost of equity or the firm is 11.76%. In the column 2, 3, 4, 5, similarly you see that the value of the firm is constantly decreasing and overall cost of capital is increasing as you see in the last row. So we can conclude from this table that the first plan will be the best. The firm should go for a debt of 3 lakhs at a 10% per annum. Illustration 6. X Limited and Y Limited belong to the same risk class. KE for the firm is 12.5%. X Limited has raised 50 lakhs while Y Limited has raised 70 lakhs by issuing 10% debt. Find the value of these two firms applying the NI approach. Both the firms have an EBIT of rupees 12 lakhs. Solution. You can see in the table and determine for yourself that the first situation is giving the overall cost of capital at 11.3%, while in the second situation you observe from the last row of this particular table that the overall cost of the firm has gone down from 11.3% to 10.99%. So naturally the second situation is better for the firm. Illustration 7. A company current operating income is 4 lakhs. The firm has 10 lakhs of debt at 10%. If cost of equity capital is estimated to be 15%, then let's find the value of the firm. Solution. Value of the firm using traditional valuation approach, EBIT is 4 lakhs, interest payable on the debt is 1 lakh, profit after tax is 3 lakhs, the cost of equity is 15%, the cost of equity portion is 3 lakhs divided by 15% is 20 lakhs, while the value of the debt is 10 lakhs. So the total value of the firm is 30 lakhs. If you see the overall cost of capital, in the second case, it is 13.33%. EBIT upon V, which is 4 lakhs divided by 30 lakhs, is 13.335. In the third situation, B is 10 lakhs plus 5 lakhs debt is 15 lakhs. KO is 12%, KE is equal to 18%. The value of the firm depends on the earnings of the firm. The earnings of the firm are divided among three main claimants: the debenture holders, the shareholders, the third claimant is government. Earnings of the firm, that is EBIT, is determined by the investment decision. The value of the firm would be the sum total of value of debt holders and shareholders. Overall cost of capital, that is weighted average cost of capital, WACC, can be changed by changing the financing mix. Different theories have been expressed regarding the relationship between the leverage, cost of capital and value of the firm. These relationships are also expressed as theories of capital structure. These are net income approach, net operating income approach, traditional approach, approach, that is Bottigliani and Miller approach. This theory states that there is a relationship between capital structure and the value of the firm. Therefore, the firm can affect its value by increasing or decreasing the debt proportion in the overall financing mix. According to NOI approach, the market value of the firm depends upon the operating profit and overall cost of capital, that is KO. The financing mix is irrelevant and does not affect the value of the firm. Traditional approach, the NI approach and NOI approaches hold extreme view on relationship between leverage, cost of capital and value of the firm. Modigliani-Miller approach, this model propagates that capital structure and its composition has no effect on the value of the firm. They have shown that finance leverage does not matter and the cost of capital and the value of firm are independent of the capital structure.